This video alone could help you reduce your taxes by $20,000 to $30,000. I'll keep a running tally over here on the side so that we can keep track as we go. Everyone wants to pay less in taxes, and there are a million people telling you what to do. I'm not going to tell you what to do. I'm going to tell you what I'm doing for myself. Why? Because I'm a CPA and I know what I'm doing. Also, because you can do these things too. Lastly, a ton of the advice that you hear on TikTok and YouTube is garbage, that is either completely wrong or is missing the context to be able to do it correctly. Anyone can do a majority of the things that I'm doing, and many of you will be able to do all of them. I like to take the low-hanging fruit. I'm not doing overly complex things. Some people like to intentionally confuse you in hopes that you'll have to hire them because it's too complicated to do it on your own. My goal is to make things clear and understandable. If you like that, please like this video, share it with others, and subscribe to the channel so that you're notified when new videos come out. Thanks for watching. I'm married, I have 3 kids, and I own my own business. If you don't own your own business, then 1 or 2 items won't apply to you, but the rest will. Let's start with the easy stuff. I get a W-2 salary and I have a simple IRA plan through work similar to a 401k plan with some minor differences. I defer some of my pay into the simple IRA on a pre-tax basis, and the company matches it up to 3% of my salary. The money that I defer reduces my taxable wages, and the company match doubles my investment immediately. That's a 100% return on my money, and that's the best return I'll probably ever get anywhere. About 50% of Americans make less than $75,000 a year, and about 50% make more than that. So we're going to assume a $75,000 salary and that you're contributing 3%. So let's say that you defer that $2,250 into your work retirement plan and that you're in the 12% tax bracket. That reduces your taxes by 12% of $2,250, which is $270. You also receive $2,250 from your employer, which is not taxed at this time. That's a match that you otherwise would have never received had you not taken advantage of this employee benefit. If you have an employer plan, I would utilize it at least up to the match. Last year, we put $6,000 into my wife's IRA. This was allowed as a tax deduction on our tax return, and if you meet the qualifications, you can deduct this as well. Again, assuming that you're in the 12% tax bracket, this would reduce your taxable income by $6,000, multiplied times your tax rate of 12%, which equals $720 in tax reduction. My wife has a Roth IRA as well. I chose the traditional IRA simply based on what our taxes were looking like when I prepared the return. We were going to owe, and I didn't want to. So I reduced our taxable income by using the traditional IRA instead. I do like Roth IRAs as well, and it would have probably been better in the long term, but there are many factors that influence our decisions, and to assume that we make every single decision simply based on the long-term mathematically best option is naive. Also, we do have some money in Roth accounts already, so I'm not ignoring that option altogether. If you meet the requirements, you could also put $6,000 into your own IRA. Now this would double the reduction in taxes to $1,440. Speaking of Roth, I did put some money into my Roth IRA. It's important to note that the IRA and the Roth IRA limits are not exclusive of one another. If you max out your IRA limit, you cannot also max your Roth IRA. You can put the money into both, but the limit is cumulative between the two of them. For example, if the limit were $6,000, you could not put $6,000 into your IRA and your Roth IRA, but you could put $2,000 into one, $4,000 into the other for a total of $6,000 as long as all other requirements are met for eligibility. Another thing that we did last year was we bunched our charitable contributions. The standard deduction was doubled back in 2018 after the Tax Cuts and Jobs Act. Most taxpayers no longer itemize their deductions, and we would have been in that category as well if we didn't bunch our charitable giving. The most commonly itemized deductions are home mortgage interest, home property taxes, and charitable contributions. Ours don't exceed the standard deduction in a single year, but they are close. Many people are in the same situation. So after giving our normal charitable gifts in one year, we gave the following year's gifts early at the end of that year in order to push ourselves over the standard deduction and get a tax benefit for those items that we otherwise would not have received. If you Google bunching charitable contributions, you'll find plenty of explanations on this strategy. The benefit is whatever your itemized deductions end up being above and beyond the standard deduction multiplied by your tax rate. Let's say that you're able to get an extra $5,000 above the standard deduction by using this strategy. Multiply that times the 12% tax rate that we've been using in our examples, and that would be $600 in taxes saved. Another thing that we have done is chosen a high deductible healthcare plan, which allows us to participate in a health savings account. If you put the maximum of $7,300 for a family plan into that account and receive a tax deduction, then you multiply that by the 12% tax rate that we've been using, that would be $876 in tax savings. HSAs are great because the money is deductible when it goes in, it can be invested and grows tax-free while it's in the account, and it's tax-free when it comes out, assuming that you use it for qualified medical expenses. No other account can be tax-free in all three situations: when it goes in, while it's in, and when it comes back out. We didn't do this one last year, but we do plan on putting solar on our house this year. We'll receive a 30% tax credit based on the price of the solar. Our out-of-pocket cost compared to our average electric bill means a break-even point of about 7 years for us. Now, I only recommend doing this if you run the numbers and it makes sense, not simply for tax savings. We plan to be here longer than 7 years, so we decided that it's a good investment at this time for us. All the tax credit does is reduce the cost of putting the solar in. It doesn't really save any taxes. Sure, I get a tax credit, but I have to pay for the solar in order to get it. So instead of viewing this as tax savings or reducing my taxes, I see it more as reducing the cost of the solar. However, that's money from your taxes back into your pocket to reduce the cost of the solar. So let's assume that you put in a $30,000 system and you get a 30% credit. That's $9,000. We haven't done this one, and we don't plan to in the next year or two, but perhaps at some point, and that is to purchase an electric vehicle. There are several limitations and qualifications, but it's possible to get either a new or used vehicle that qualifies for a tax credit. The maximum credit is $7,500 for new vehicles and $4,000 for used. Let's say you buy a used car and you qualify, and that's $4,000. They're also going to make this one where it's possible to get this off of the purchase price of the vehicle, in which case you won't have to wait until you do your taxes to benefit from it. Now, I mentioned that I have a W-2 job. That is my CPA firm, and I set it up as an LLC, and I elected S Corporation status. This means that I receive some of my pay as W-2 wages and some of my pay as owner distributions. If I reported all of my earnings on Schedule C, the entire amount would be subject to income tax and self-employment tax, which is Social Security and Medicare taxes. However, by utilizing an S Corporation, I'm able to reduce my Social Security and Medicare taxes. All of the net earnings are still subject to income tax. However, only what I receive as W-2 wages is subject to FICA taxes, which is Social Security and Medicare taxes. The owner distributions are not. For this strategy, you have to pay a reasonable compensation, which is the fair amount of wage someone doing your job at a company your size would be paid in the marketplace. Many people make this number way too low, and they run the risk of penalties and interest if the IRS catches this and then recharacterizes owner distributions as W-2 wages. There are several factors that go into the savings here that are too detailed for this particular video, but on average, let's say that you could save about 11% on the amount paid as owner distributions instead of having it reported as self-employment income on your Schedule C. So if we assume that you have a business netting $100,000 after expenses and your reasonable compensation needs to be $60,000, then you could save about 11% of the $40,000 difference between those two, which would be $4,400. The S Corporation means a few additional expenses, so let's reduce this sum to be fair and call it $1,500. In my S Corporation, I had a few, not many, but a few expenses coming up in January that I was able to pay for in December. As a cash basis taxpayer, this meant that I reduced my income this year. At this point, you're probably in the 22% tax bracket. So if you were able to do this for $5,000 worth of expenses and you're in the 22% tax bracket, that's a deferral of income tax of $1,100. You don't save that tax, you defer it. Those expenses would be incurred in January and they would reduce your taxes next year. So you didn't do anything except reduce your taxes a year earlier. But when you can't get out of taxes altogether, deferring them into the next year is the next best thing. Your IRA and your 401k is really just a deferral strategy as well. You get the deduction now, but you'll pay the tax on the money when you take it out of your account in retirement. Similar to accelerating expenses is deferring income. If you're going to bill and collect $5,000 near year end, but you can wait and do that in January, that would also defer another $1,100 in taxes if you're in the 22% tax bracket. Now this one isn't a strategy, but we also qualify for the child tax credit. We have 3 kids and the credit we receive is $2,000 per child. That's $6,000 of child tax credit. That's not a deduction, but a credit. so we do not have to multiply that times our tax rate. It reduces our taxes dollar for dollar by $6,000. Now, we didn't have kids for the tax credit, so it isn't a strategy. You also won't miss this credit unless you simply enter your dependent information incorrectly on your tax return. So get that in there correctly, and the tax software will do the rest. Many people will put this on their list of tax strategies, but like I said, you either get it or you don't, and you didn't have kids for the tax savings. So I'm not counting that one as a strategy. I think that's everything that we have done and are consistently doing right now in regard to tax saving and tax deferral strategies. Someone will probably comment that there's a whole bunch of other stuff that we could be doing and that we're dumb for not doing it. But life isn't all about minimizing taxes. These are the things we're currently doing where we believe that the trade-off of savings versus the effort is actually worth it. I have other videos on that particular concept, but in summary, if I could save $1,000 in taxes, but it causes me to lose sleep at night, or if it cost me 1,000 hours of research and effort to do it, or if it didn't fit in with my other values and goals, then it simply wouldn't be worth it. I make my tax strategies fit my life. I don't make my life fit my tax strategies. If you want true peace of mind, I suggest that you do the same. In my opinion, too many people are overly focused on taxes, and it's costing them peace of mind and reducing their overall enjoyment of life. So here were just a few basic, tried and true, time-tested strategies. And even with just those, what did our total end up being? $19,886. I have to give you one more caution though and give you the full truth so that I don't fall into the trap of the other videos that are out there, which are very misleading. It's very unlikely that you could benefit from all of these in one single tax year. Why is that? Well, in most of the examples, we assumed a $75,000 salary. It could be quite difficult to come up with $12,000 for 2 IRAs, plus thousands in additional charitable giving, plus money for solar and an electric vehicle, all in 1 year on that salary. Additionally, the solar tax credit and the electrical vehicle tax credit are non-refundable tax credits. It's possible to qualify for the credit but not receive the full benefit in a single tax year because your tax liability is not high enough to utilize it. So you really need to speak to a tax professional who can look at your specific situation and give you specific advice. What we choose to do and what works for us may not be what you choose to do and what works for you. If you like this video, please share it with others and also check out one of our other videos.